Are you on the telephone?
No. I'm on a
Oh,
headset here. Can you
okay,
hear me?
buddy. Yeah, how are you?
I'm
Loud and
good.
clear.
I'm good. You
Good.
guys did some good work there. Nice professional setup you got going. Congratulations on that. I tip my hat. A lot of different voices, which is important, and a lot of stuff covered. It's pretty good.
Well, we have a promo going. You should join. So anyway, if you want to share your screen.
Dale, you're capable of selling fridges to Eskimos.
Yeah. Well,
what do I do? I click share here?
Yeah, the green
Yes,
box.
you click the green box saying "Sir," and then you're going to get a screen asking you, which screen or which window you want to be sharing.
How's that? You see my trading view here?
Yeah.
Got it up there. So tell me, my trading warrior brother, I see this chart up here. You're looking at notes. So is this on your radar? And is this pullback in the notes an important, significant top, or you thinking a break to buy if there's some more risk off? Where's your head at?
Yeah, we think this is the main story for the rest of the year, and this is going to drive every other market is basically boons. At the long end of, you could pick your poison, gilts, JGBs, 10s.
Bear market?
It's the beginning or the end of the bull.
Okay.
Is basically what we're saying. I wouldn't call it a bear market, but I mean, rather than look at the futures charts, I think I would encourage people, and I know there are a lot of youngsters or sort of new people out there listening. If you're going to trade notes, if you're going to trade notes or if you're going to trade fixed income, you kind of have to look at the yield chart, especially if you're going to trade it technically. And it gives you a better feel for what exactly is going on. So this is the yield chart. We're actually obviously selling the futures to get long the yield. And you saw the turn down here at 150, but the turn for me really was ECB. So let me put up the boons first.
Okay.
So boons are more important. We have this negative yield, which of course is patently insane. It kind of removes the notional idea of why we have bonds.
Sure does.
They're income instruments, and people have lost. I mean, this simple fact has just been lost on this market that's caught up in this rhetoric, caught up in this ECB speak, and then it was caught up in momentum, right? I mean, CTAs buy them, it goes higher. They buy them, it goes higher, and this is just what they do. And people forget that if you buy boons here and you hold them, you're going to lose money. And so we were just waiting for the turn. The ECB gave us that turn by basically what I thought was saying, this is a change in structure. We're going to go no lower in rates, and we need fiscal help. It was like a cry for help from Draghi, I thought. And he's basically saying, we lowered rates almost because we had to. We said we were going to, but we're desperate for fiscal help here in Europe.
And what'd they do? Throw confetti on him?
Well,
remember the confetti episode?
Oh yeah, was that flour or confetti?
It was confetti, yeah. And you know what? Mario, it frightened him. He ducked. Yeah.
Well, that was a bit scary, though.
I don't want him in a foxhole with me. Anyone that's afraid of confetti, you know what I mean, Privateer?
Yeah, he's not a guy. He's not a street fighter, that's for sure. Those
central bankers, Yeah.
Ex-Goldman central bankers, pretty soft. I agree.
Yeah.
Anyway.
So then this is a major shift. Because we've been, is there, I've read some interpretations that this bounce in yields could still just, in Elliott terms, just be a 4, and there could be one more shot down. The bonds took out their record low yield, and the 10-year did not. Is there a possibility that that happens, maybe if we get some risk off in S&Ps?
Yeah, I mean, of course, if that does happen, Privateer is going to take a loss because we'll be stopping out if we make new lows in fixed income.
Okay.
But our main premise here is that we've had the turn here, and especially because even if we have 200 handles in the S&Ps, which is obviously a pretty big move, we're still going to be up 10% for the year. It's no big deal. We're 0.5% from the highs, from the all-time highs. So what I think is basically going to happen is even if they cut rates, it's going to create this, the long end is just going to steepen. It's going to create this fear of inflation.
Yeah.
We've already seen a little bit of wage inflation. We saw the CPI coming out stronger. And I just think there's a mentality change now that as soon as, I can just sort of sense it, the way the media is playing with negative rates and the way the media is saying, listen, this blows up Western finance. 10-year rates at 1.5% blow up pension funds. They blow up insurance companies. They blow up bank balance sheets. All of these institutions on the asset and liabilities management need to invest in income producing financial products. And when all these financial products yield zero, you create this huge, massive hole. And people are slowly starting to get their heads around this. And you're going to see, I think, central banks recognize, we've seen governments recognize it. I mean, I don't know if you saw the Netherlands, they sent a letter to the ECB saying, please, no more negative rates. You're killing us. Obviously, the Germans can't stand this. They're quite good with money. They're good savers. And this is penalizing all of the good savers in the world.
Yeah, for a decade.
Yeah, and all the retirees in the world. I mean, God forbid, you put 3 million in the bank and you're saying, I got 6%, 180 grand a year. Now 3 million in the bank, your yield is 30 grand.
Well, didn't these pension funds with this, what they call it, income suppression, with this going on, didn't it push pension plans out on the risk curve?
Absolutely.
So that if there were bear markets in some of the instruments they're invested in, that could really be the nail in the coffin. And I think in the U.S., the pension benefit government insurance plan is only a drop in the bucket compared to all the pension plans here in the U.S. So is it really going to be rates, or is it going to be other asset classes? Go ahead, Steve.
All that, Dale, is half the story, because the other half of the story is that, from Austrian economics, in my opinion, the only school of economics that really understands what happens to the real economy, low rates create what they call malinvestments. So in essence, they turn factors of production to doing stuff it shouldn't be doing, and that shouldn't be viable under normal circumstances. And that is why you get all those big busts following. So in essence, not only you penalize savers, not only you draw blood from the only productive part of the economy, because don't forget that some people don't remember the most basic stuff. Investments, an economy grows by investing, right? You invest in order for you to increase productivity in something. Okay, now, how do you invest? Where do you find the money to invest? You need somebody to save that money, right? What is savings? Savings is under consumption. You hold consumption for now so you can have money
gratification. Yeah.
So it's a whole vicious circle that goes around and around since mostly like the 80s, 90s, and it seems to be getting worse by the decade.
By the way, Privateer meets Steve Volge, one of the partners here.
Yeah, I think we're on the same page. I mean, our main premise about this, and the reason I bring it up, because I cut my teeth in FX. 90% of my P&L for the last 30 years has come through FX. So I'm no fixed income guru, but I do see this is an element of the market that is going, and I do think this is the element of the market that's going to cause the big risk off, because this is the portion of the market where everyone owns the dog shit. So if you think about 2008, CDOs and all of these, that was the dog shit that created the sort of crash down.
Right now it's corporate debt.
Here it's triple B. It's junk. It's the corporate debt that's junk that only yields 1 or 2%. It's 1.8 trillion in bonds that are negative yielding. You're basically taking a loss by owning this unless you bail out. And what people don't realize is, their time is working against them. So there's just going to be this mass exodus, like it always is.
Exactly.
In 2000, it was the junk stocks. In 2008, it was the AAA rated junk fixed income instruments. Now it's actually going to be shitty corporate debt, and also, frankly,
Government,
shitty
sovereign?
sovereign debt. Yeah.
Yeah.
I mean, who the fuck wants
Everything.
When the market at some point, and it's inevitable, will need to reprice risk on all those instruments, it's going to be a massacre like nothing we've seen before.
Well, it's the most crowded trade, I think, in the history of mankind. In fact, last year, Privateer, didn't all that huge withdrawals or liquidation of equity funds all piled into bond funds, and the world is like it's the most crowded trade on the planet. Bonds.
Well, this is another page that you have to bring into this. And, you know, if you're doing a trade and you need a story, the story here is very persuasive. Now you just have to time it right. I'm arguing that this is just the beginning. The first inning was last week. But onto your point, you know, Dalio came up with this risk parity idea, right? So I'm going to be 4 times leveraged bonds, which will cancel out my downside risk in equities. So I'm going to have 50% of my stuff in equities, and I'm going to be 4 times that leverage in bonds. And so it's risk parity. So no matter what happens in the market, I'm going to make money. I'm going to either make income.
I have one word for that: stagflation.
Yeah, I mean, well,
because if we get, okay, whatever the chance is, if we get stagflation, this guy is going to be losing from both ends.
Yeah. Well, Steve, this guy, let's give him some credit. For the last 20 years, he's made 20%.
No. I do give him credit. I mean, there's no question about it. I mean, he's not a random guy. But I'm saying, by saying that, okay, I'm hedged no matter what. No, dude, you're not.
I totally agree. And what's worse is, and I was coming to the punchline here, I don't worry about Ray Dalio managing risk at Bridgewater. What I do worry about now are all these Muppet ETFs that have replicated this strategy without fully understanding the risk. And the risk is not price. Anyone can calculate price. Price goes up, there's basis points, you get dollars or you lose dollars. The risk is in liquidity. And again, it goes back to the whole thing. The position size is too big for the door. And what happens to that, you know, that's when collapse happens. And so when the
like Bobby Axelrod better than Ray Dalio. You know him?
Yeah, he's on that program Billions, I believe.
Yeah, I think Bobby's pretty good.
We don't have that in Switzerland. Is that on Netflix or something?
I think HBO. It may be on Netflix. You got to check it out. All right. So the first inning. Let's kind of go with where do you think we'll be at the 7th inning stretch? Back to 3 1/4 on the 10-year. Last year's highs.
10 goes to 3 1/4, probably to 3.5. Boons go to 1%, which is the sort of their natural state. And there'll be a couple of things that are going to happen when this happens. So the majority of
weaker dollar.
Yeah, I'm going to get to how this is going to affect the dollar. The majority of these investments are in the U.S. So you're going to see for the first time probably, and many youngsters have never seen this, but you're going to see basically U.S. fixed income get smashed. And then the funding costs and just the fear is going to bleed into an already nervous equity market. That's going to go lower. And so what's basically going to happen is you're going to basically see people leaving U.S. dollars. So all foreigners who own NASDAQ, who own S&Ps, who own these risk parity funds, or who own just U.S. fixed income, because it's the only fixed income in the world that has any kind of yield, are then going to have to repatriate. And you go, where is that money going to go? And there's really only sort of 3 choices, right? It either goes into the euro, it goes into the yen. You might argue it could go into the yuan, but I think that's a false argument. But let's just say it's probably going to go into the euro, because the huge insurance companies, the huge pension companies that have these investments are in Europe. Think of, the biggest German, insurance company. And so you'll see the dollar get hit, and then the majority of this ironically, is going to go into what will be sort of this new safe haven, which is going to be the euro. And the reason it goes into the euro is they're now tightening, or at least, you know, they're not going to lower rates anymore. They've kind of basically said that. At least in my head, that makes sense to me. A lot of people are questioning that. The US is going to have to lower rates because there'll be panic and Powell's a pussy and the president is screaming at him. And there'll also be a general convergence of rates. But euro rates are going to either stay the same or go a little bit higher. US rates are going to go lower. And then there's going to be this, you know, this migration out of US stocks and US bonds. So there's three ways to make money here. I think the first and the easiest way, sort of your first derivative, is to be short fixed income.
Okay.
Then your second derivative is, and this is kind of one of everybody's favorite trades, is short equities. You know, people love being short equities. There will be some slippery days in equities. And like I said, equities can easily go down 200 handles and you have the 200-day moving average down there. It means nothing. It's still up 10%. I'm not saying equities are going to go down 400 handles, although they could. They easily could. I wouldn't go out on a limb and say that, but there will be money to be made.
Yeah, won't the narrative change with higher yields as far as
Yeah.
when you're looking at
Capital allocation? Yep.
Well,
it becomes,
you know, just yield. You know, just the competition on the yield for the market.
correct. I mean, there's so many. It becomes like a self-fulfilling prophecy if this happens.
Nowhere to hide.
Exactly.
Except the euro.
Well, ironically, the junkiest currency that we've all been kicking, like, you know, and punching, beating that crap out of, is going to be the place where the money flows to. And you know,
160, 160.
No, 124.
Okay.
You know,
all right.
I think
that's fine.
I think you know, 116 is still fair value. I mean, everyone in America goes, "Oh, euro's going to go to 1," and 111, 110 is kind of low for us. For those of us who live in Europe, we're kind of like, you know, people in America don't really understand the euro, I don't think, as well intrinsically as we do over here, in a sense that we opened at 116, we went down to 80, we've been up to 155.
Yeah.
116 is kind of neutral, 118 is neutral. It doesn't even get exaggerated until 125, 126. So a move to 123 happens very quickly, especially if fixed income leads this. And for me, this is how it has to work. It's 1, 2, 3. It's fixed income, that cracks the stock market, and then it'll be the currency trade. And so going to the...
I was talking about the same thing. Fundamentally speaking, I mean, many Americans think, oh, the euro is like, you know, currency, like, oh my God, it's, you know, who would want to be there, etc.
Toilet paper, right? Yeah.
Toilet paper. But, you know, besides indeed some existing political risk, the Eurozone economy as an entity, so let's say the market discounts a chance of a breakdown of the Eurozone at some point. But if you're looking at shorter term, so you have to take out of this, you have to take that possibility out of the equation, because that's not like a, you know, short-term thing to come, even if it happens. The Eurozone economy is an exporting economy with a positive trade balance, with very, very, very manageable deficits, and a lot of countries, and some of the big ones, that have excellent economies. So if you compare the two economies, so if for some reason the Eurozone became a federal, country, like the US, I mean, the Eurozone would be at so much of a better place than the US at the moment that it wouldn't even be funny.
Here's something you might enjoy this, Dale. Obviously, I'm American. I've lived over here for 20 years. You know, I have European passports now. My kids are more European than I am. But here's something that I learned over here that you might find interesting or relate to or not relate to. Everyone shouts about Europe having low growth, and we do. Compared to the US and compared to China, we have low growth. But what people don't understand is, in Europe, like, we don't need 3% growth. People are just happy with stability. And what Europe has is just stability. So just a tiny little bit of growth is fine over here. And we have all of these social networks and social nets for populations that it's built for stability here, whereas the US is built for growth. And people are in a psychosis in America going, we need to grow more, we need to grow more, we need to grow more, we need to grow more. But that's where the boom bust comes from, because at some point you can't grow anymore. Growing is not an infinite line. And people forget about, people can't wrap their heads around the fact that if we're growing at 0.5% in Europe, the population is totally happy. Food is on the table, the schools are open, the buses are on time.
Does the U.S. need more growth to generate more tax receipts to handle huger deficits in Europe?
Yeah, absolutely. And
that's why we, that's the reason
US,
for it, right?
The U.S. needs to stop spending on defense or stop, that's the big problem.
The US needs to return back to the roots that made it one of the greatest economic miracles we've ever seen. It needs to stop pretending that an economic model of everybody consuming money they don't have is the way to prosperity.
Is the correct way, yeah.
And go back to having an economy that actually produced. And many people don't know history of economics, but the US used to be the biggest exporter ever.
We laugh at Japanese products.
Despite the fact that it had by far the most expensive wages. Despite the fact that it had the most expensive wages.
Yeah, well, Henry Ford knew you had to pay your employees so they could buy his cars.
Let me just, I'll chuck some good stuff in there about wages. In Switzerland, our minimum wage is like, I don't know, about $24 an hour. In Germany, the minimum wage is like 20 euros an hour. And they still we export everything everywhere because we do good products. So it's not even about the wages. It's about what, Steve, what you said is about, it's a mentality that, America's not just chasing its tail. It's a cultural, and they need a cultural break. And one of the things that you guys said, I laughed, and this kind of apropos, without trying to, being like a misogynistic jerk or whatever. So I'm not going to use the word wife. I'll just say partner. America needs a partner to like a practically minded partner to rein itself in. And it seems like, America doesn't have a wife. It's just the impulsive guy, is to use the metaphor you guys are using, but they need to control those impulses, I think. And I don't know if they can, and it's no big deal, because as America crashes again, which it inevitably will, it will also rebuild itself quite well. This is the American way. It goes up to higher highs than we can possibly believe, and then it crashes to lower lows that we could possibly believe. The whole world's going to end.
The rubber band.
Is itself, right?
The rubber band always stretches further than we think.
Right. We're in Europe. We never have crazy lows. We never have crazy highs. We just, get our fresh bread and have dinner together,
You're like EKG of someone that's in a coma.
Yeah, we have a friend here, Ingmar, saying that German minimum wage is $8.90 and goes to $9.20 in 2019. Just a fast comment about that. It shouldn't. There should be no minimum wage in any kind of an economy. Minimum wage is not something that protects workers, it's something that actually harms them. Simply put, minimum wage is a barrier.
I feel a debate coming here.
Yeah.
Oh, you can.
Go ahead.
I hear your cry on this. I hear your cry on this, and in a textbook that is correct. But there are certain people within every population that need a little bit of help. That probably aren't worth that $9.
Absolutely.
But they need a living wage.
Exactly. Absolutely. That is why you should let the economy function as a free market. Because if you said, let's say we set a minimum wage at €9, what does that mean immediately? It means that every person that isn't equipped enough to have a productivity worth €9 per hour to their employer, in essence, is rendered by law illegal to be employed. If you have a person with diminished skills that, let's say, can only produce €7 per hour, it's like saying to the employer, that person can never be employed. So do I believe that people that cannot make a decent amount of money to live should be helped by some economic government plans? Yes, they should, but there should still be no minimum wage. They should let the free market balance the way it wants, and then as a government, you can go to sensitive parts of the population and say, okay, some people are making less than they would need to to have, let's say, you need to have a decent life. So let's make some kind of a program to help those people outside of what the free market does. Because if you try to regulate the free market, all you do is you'll create more employment and perhaps get some people that really want to work even for €7 per hour, do either of the two. Either work under and get paid under the table, which is good for nobody, right? Or stay permanently unemployed.
I hear your cry, Steve. I'm of that sort of libertarian mold, but also as I get older, I do realize, and there's some dignity questions within your argument that you're not really respecting, and it seems disingenuous for the three of us on this phone here. We're all in financial markets. We've all done very well in our lives. To be kind of putting on these empathetic shoes and saying, I know what it's like to work at minimum wage. If you work at a grocery store and you're only putting out €7 worth of value, you still should get paid $9 for your own dignity's sake, for the sake.
I haven't always had great times.
The employer should not be paying that. That's what I'm saying.
But then there's a dignity issue. You don't want handouts either. I disagree. The employer and the corporation has a social, social responsibility.
Yeah.
Yes, they have a social responsibility. You know how it's called in one word? Taxes.
No, I disagree. The responsibility of a corporation is to provide work for people.
As a testament to that, let me tell you what Ingmar wrote back. It's not working in Germany. Employers circumvent minimum wage in many ways. Unpaid extra hours, unpaid standby hours, you name it.
Yeah, they do that here too.
Exactly. Yeah. Why, guys? Because the market will always try to bypass clots in the circulation of the economy. And, legal obstacles are clots.
This is a good conversation. This could go on forever, but I will just say this. It's not the fault of the system that corporate guys are taking advantage of the system or looking for shortcuts. It's the problem of the people themselves, and humanity has a problem. A lot of humanity has a problem. Capitalist humanity has a problem. And don't get me wrong, I'm not a socialist, I'm not a communist. I'm not sure I'm a capitalist either, but we need to recognize that it's more than just about dollars and cents. There's humans.
Let me boil it down. 40 years ago, if you saw someone that was poor, you would say that they were unfortunate, compassionate, right?
Yeah.
Now it's they're
scum.
Whatever.
Yeah.
Right. I mean, that's a big difference.
It's a bit upside down, all of this.
Yeah, that's what I'm saying.
And
guys,
textbooks.
Guys, don't get me wrong. It's not that I'm not sensitive or I don't love human beings or whatever. I'm just telling you that if you want to help somebody, you can't do that by enforcing laws to an economy, because the economy always has ways to bypass those. So what I'm trying to say here is the following. If you want to help somebody, you have to do it in a manner that will actually work. In essence, in a manner that won't go against human nature. Because if you're trying to regulate a minimum wage, as our friend wrote there, and I have the same experience from Greece, employers, employees, and everybody else will find a way to bypass it and illegally achieve an equilibrium that, comes from, demand and supply. Because don't forget, what is the wage? What is the hourly wage? It's a price. A price of what? Of one work hour. So who settles that? Demand and supply.
No,
as simple as that.
That's not true. That's not true.
If somebody cannot make, enough to make a decent living, I'm not saying that they should be left on their own, at their own luck. I'm not saying that. But what I'm saying is that you can't help them by putting in place a minimum wage. Minimum wage, as many things, are good politics, bad economics. And usually what is good economics is bad politics. Because it is very easy to tell somebody that is employed at the moment, don't worry about it, I'm going to raise your minimum wage, let's say random numbers, from $7 to $8 per hour. They're going to be like, oh, nice. What they're not thinking is the victims of this, legal change that you cannot see. The person that is not going to find a work at all because there is no employer willing to give them $8 per hour. But there might be an employer out there willing to give them $7.
Okay. All right. Why don't we
let's
wrap
go back
up
to currencies. Yeah,
wrap up with some of these markets, because we could go
circular,
through a bottle of tequila over this. All right. Go ahead.
Let me just throw the most simple chart and the easiest way to express this currency trade. We saw it on Friday, and I actually thought Friday, I got a bit twisted on Friday. Long euro crosses, euro Aussie, euro CAD, euro Kiwi, euro dollar, euro yen. It all lined up beautifully on Friday. And then everything got scratched. But here's the trend line in euro. You see it on it's a very simple trend line. Yeah. We have 3 touches.
Yeah.
For me, it's quite straightforward tomorrow. If he cuts and is dovish or sounds afraid or is interpreted as dovish, you get long through 95, which I think was yesterday's high. You add through 10, and then you respect this trend line. Probably trade to an average, because we have, you have basically a few more central banks to get through this week. We've got SNB, we've got BOJ, we've got Norges Bank, and then core longs after we break this line. And ideally, you'll see Bunds lower, the entire fixed income market lower, which is going to confuse a lot of people, because as rates, the US 10-year rates go up, people are going to go,
they would think, it should be a strong dollar.
When
it weakens the country.
Yeah. My premise is this will be outflows from the US coffers.
Yeah. Anything US dollar denominated assets, equities, bonds, whatever.
Correct.
And
that will create what you guys, I think, are talking about on the equity side, this day of reckoning. It'll clean out some of these zombies, and it'll also force just a more natural level for junk bonds, for shitty instruments.
Continuation of the bull market in precious metals with this going on?
I would suggest yes.
Okay. And energy, any view with what's happening geopolitically?
I do have a view. I wanted to bring that up. Let me just pull up the CL chart and the monthlies. A lot of people listening to this call weren't around in 2003 when we invaded Iraq. So here's the monthlies.
Oh, yeah.
Here's the monthlies.
I was there for Gulf War I.
That was what, 98 or something, or 99?
Early 90s.
Early 90s. Yeah, I was in college.
Yeah.
Here it is.
Don't
right
rub
here.
it in, man.
You're young at heart, Dale.
Yeah, I know.
Here's the March 03, which was the sort of quick down and dirty invasion to Iraq. So we had the blip up, but then we had a move from $39 to $24. That's $15. That's like a 50% move almost. It's a 40% move lower.
Yeah. Before
we went higher. Yeah. So I'm just cautioning people, because it looks quite bullish. The players are all psychopaths. You got MBS in Saudi Arabia, you got Rouhani in Iran, you got Trump. These are sort of egotistical, sort of sociopathic guys who you don't really want at a negotiating table, who sometimes aren't really thinking super clearly about like secondary consequences and tertiary consequences. And now you have also what looks like, a Saudi patch of oil, or 4 patches of oil. So there's Gawar and 3 other ones that are easily attacked. I mean, what the hell? 10 drones? They did this much damage? Imagine if there was 100 drones, and those drones are 25 grand a pop. I mean, I know guys in the hedge fund world who would just send 10 drones because they're long oil. All jokes aside, but I just want to caution people and say, even if the U.S. goes into airstrikes into Iran, which would be awful
Yeah.
on so many levels. Oil will probably blip up on that, but if that turns into a global recession and demand goes down, and it's just a tricky, and I'm not a good oil trader. I don't trade oil a lot. I just want to recognize, like every single time we're in a market, you have to look both ways. And this looks incredibly bullish. The story looks incredibly bullish, but it also looked bullish in 2003, and it dropped 40% after the Iraq invasion.
So be careful. People who buy headlines today sell newspapers.
Be careful. Leave your stops in. And I know stops are tricky and crude, leave plenty of slippage. Just be careful is what I would say. I don't have a dog in this fight, but I can remember from 03, some of my friends got massacred on that because it just didn't make any sense, right?
You were finally out of college. Anyway, my trading warrior brother, I really had a blast talking to you and having Steve jump in, and you know, I have the drift, really real good narratives that you presented to us today. What's the best way for people to stay in touch with you?
You know, I'm not the only guy in this thing. We've got a guy in America who does our weekend videos. He runs a systematic. He's got this beautiful systematic fund that he's going to be starting. And then we also have a guy in Ireland who's more of you know, kind of just a media guy. I guess Twitter is the best way to say hi if you feel like saying hi.
Okay.
I mean, what I do in my morning videos, it's just basically a trading, it's just basically my trading book that makes me accountable. And one of my friends said, can I use that? And we'll create this channel with it. I don't know what we're going to do with it. It's just me being accountable to me. So I say what I'm going to do, and then it's recorded, and then it makes me more accountable to do what I just said. And then that's what we do. And
yeah,
we're like just three old guys who've been in the markets for 30 years doing our thing. But Twitter's the best way to find us, I guess.
Okay, Privateer. Well, you know, may pips rain down on you and your partners during this fall season and into the Fed. And I really appreciate you bringing some very insightful views and markets that are at pretty important inflection points. So thank you for edifying our community today, buddy.
Beautiful. Good luck to you guys. I wish you well, and we'll see you along the way.
All right, buddy. All right, everyone. That's a wrap for Turnaround Tuesday. Everyone have a great day. Don't forget the promo's running. I think Privateer should sign up, even though he probably doesn't need to. I think he should. And most people listen to me because I have authority. Anyway, no, it's because they trust me. Anyway, so listen, everyone, don't just count your pips, count your blessings, and we'll see you for Fed Day tomorrow. Thanks again, Privateer.
Take care, Dale. Be well, okay? Ciao.
Thank you, buddy. Adios. See everyone tomorrow for pre-Fed. Enjoy.